Get ready, because the world of finance is moving at warp speed, and you're about to get the inside track on the biggest stories shaping our future. We've got a packed show today, with updates that could redefine how we invest, manage our assets, and even think about wealth itself. From the surprising shifts in global portfolios to the bold moves by industry titans, this is the information you absolutely cannot afford to miss. Buckle up, because the landscape is changing, and we're here to break it all down for you live. Let's dive straight into the action. We're kicking things off with a deep dive into Bitcoin's fascinating dual identity. Is it a safe haven, a speculative asset, or something entirely new? We'll explore how its role in global portfolios is evolving, creating a stark divergence from traditional assets like gold. Get ready to understand the new calculus in wealth management. Next, we're shining a spotlight on a potential game changer for institutional investors. Could a specific signal from a major player be the key to unlocking significant entry points? We're talking about strategic moves that could have ripple effects across the entire market. You won't want to miss this strategic analysis. Then, we're exploring the cutting edge of corporate finance. Discover how major companies are now viewing Bitcoin not just as an investment, but as a core part of their treasury management. We'll look at the trailblazers and what this means for the future of business finance. And finally, we're tackling the elephant in the room: volatility. Is it a barrier or a bridge to long-term success? We'll unpack the data and expert opinions to see how Bitcoin's inherent ups and downs are forging paths to significant future gains. Don't go anywhere. Make sure you're subscribed and have that notification bell on so you never miss an update. Bitcoin's shifting allegiance. Is it leaving gold behind? We're witnessing a fascinating transformation in how Bitcoin is perceived and integrated into global investment strategies. Once primarily viewed through a speculative lens, Bitcoin is now carving out a distinct identity within diversified portfolios, increasingly charting its own course independent of traditional safe haven assets like gold. This evolution is prompting a reevaluation of its role, moving it from the fringe to a more central position in modern wealth management. At its core, this story is about Bitcoin's dual identity. On one hand, it maintains its reputation as a highly volatile, potentially high-reward digital asset, attracting investors seeking significant capital appreciation. On the other, a growing narrative positions it as a digital store of value, an inflation hedge, and a portfolio diversifier, much like gold has historically been. However, unlike gold, which often moves in tandem with broader market sentiment or geopolitical anxieties, Bitcoin appears to be developing its own unique market drivers. This divergence is crucial for investors to understand. Factors such as technological advancements, regulatory developments, institutional adoption rates, and on-chain metrics are increasingly dictating Bitcoin's price action, creating a distinct performance pattern that sets it apart from the more established correlations seen with gold. This shift is not merely theoretical. It has tangible implications for portfolio construction. Traditional diversification strategies often rely on assets that move inversely or have low correlations to each other to mitigate risk. As Bitcoin carves out its own path, its inclusion can offer a new dimension of diversification, potentially enhancing risk-adjusted returns. However, this also means that the historical playbook for managing gold might not directly translate to managing Bitcoin. Investors need to consider new metrics, different risk factors, and a more dynamic approach to understand Bitcoin's behavior within their overall asset allocation. The market is actively debating whether Bitcoin's volatility is a feature or a bug in its quest to become a digital gold, and the answer will likely shape its long-term integration into mainstream finance. The ongoing discussion highlights a critical juncture where digital innovation meets traditional investment paradigms, forcing a redefinition of what constitutes a reliable store of value and a strategic portfolio component in the 21st century. This evolving narrative is sparking considerable discussion among financial analysts and investors alike. Many are closely watching to see if this divergence from gold is a temporary trend or a fundamental reshaping of the investment landscape, potentially signaling a new era where digital assets play a more prominent and independent role in global wealth. But this is just the beginning of the seismic shifts we're seeing. Stay tuned as we explore a potential buy signal that could open doors for major institutional players. Michael Saylor's next move, a green light for big investors. In the rapidly evolving world of cryptocurrency investment, strategic signals from influential figures can often act as powerful catalysts, particularly for institutional players looking for validation and clear entry points. Michael Saylor, a prominent advocate for Bitcoin and CEO of MicroStrategy, has a history of making bold pronouncements and strategic acquisitions that often move the market. His latest insights or actions are now being scrutinized to see if they represent a new, strategic entry point for institutional investors seeking to allocate capital into Bitcoin. Saylor's approach has consistently been to view Bitcoin not just as a speculative asset, but as a superior form of money and a Treasury reserve asset that can hedge against inflation and currency debasement. MicroStrategy's aggressive accumulation of Bitcoin, making it one of the largest corporate holders, has served as a de facto endorsement for other institutions. When Saylor signals a favorable time to buy, it carries significant weight, suggesting that the current market conditions or future outlook present a compelling opportunity. This could involve identifying specific price levels, technical indicators, or macroeconomic trends that, in his view, make Bitcoin particularly attractive for long-term accumulation. Understanding the nuances of his buy signal involves dissecting his public statements, the company's financial strategies, and the broader market context he operates within. His conviction often stems from a deep belief in Bitcoin's disruptive potential and its long-term value proposition, which he articulates through various platforms. The implications of such a signal for institutional investors are profound. Many institutions operate under strict mandates and require a high degree of confidence before entering new asset classes, especially one as volatile as Bitcoin. A clear, well-reasoned signal from a figure like Saylor can help overcome internal hurdles and provide the necessary justification for allocating significant capital. It suggests a potential inflection point where the risks are perceived to be outweighed by the rewards, and the market is ripe for strategic accumulation rather than speculative trading. This could lead to increased demand, potentially impacting Bitcoin's price and further solidifying its position as a legitimate institutional asset class. The market watches closely, as Saylor's actions often precede broader institutional adoption trends, making his signals a key indicator for the health and direction of the crypto market. The market's reaction to Saylor's pronouncements is often immediate and significant. Investors and analysts alike dissect his every word, looking for clues about the future direction of Bitcoin investment. Whether his latest signal is interpreted as a direct call to action or a subtle indicator of his ongoing conviction, it invariably influences market sentiment and trading strategies, underscoring his outsized impact on the cryptocurrency landscape. Now, let's shift our focus from individual strategies to the broader corporate landscape. We're diving into how companies are making Bitcoin a cornerstone of their financial planning. Corporate Bitcoin treasuries, a new financial frontier. The corporate world is increasingly exploring innovative ways to manage its treasury assets, and Bitcoin is emerging as a significant contender in this new frontier. Beyond mere investment, companies are strategically integrating Bitcoin into their core financial operations, signaling a fundamental shift in how corporate finance is conducted. This trend is spearheaded by pioneering firms that are not only acquiring substantial amounts of Bitcoin, but are also redefining their business models around its potential. The story here centers on how corporate giants are beginning to view Bitcoin as a strategic asset, fundamentally altering the financial landscape. A prime example is Metaplanet, a Japan-based firm that recently made headlines by acquiring an additional 1,009 Bitcoin, bringing its total holdings to a staggering 20,000 BTC, valued at approximately $2.15 billion. This move catapults Metaplanet into the position of Japan's largest corporate Bitcoin treasury, a significant development that influences market dynamics and demonstrates a growing trend among corporations to incorporate cryptocurrencies into their financial strategies. The capital for this substantial acquisition was raised through the issuance of 11.5 million new shares, underscoring the seriousness and commitment behind their Bitcoin-centric strategy. Metaplanet's bold step follows in the footsteps of other notable companies, such as MicroStrategy, which have already garnered significant attention for their proactive Bitcoin treasury management strategies. These moves are not just about diversification. They are about leveraging cryptocurrency for potential growth, financial resilience, and as a hedge against inflation and currency volatility. The regulatory environment plays a crucial role in enabling such corporate strategies. In Japan, the Financial Services Agency, FSA, and the Japan Virtual and Crypto Assets Exchange Association, JVCA, have adopted a disclosure-based approach rather than a permission-based one. This framework provides companies like Metaplanet with the flexibility to pivot their business models towards Bitcoin treasury operations, provided they secure board approval and publicly disclose their intentions. This contrasts with the more fragmented and often restrictive regulatory landscapes found in other major economies, potentially giving Japanese firms a competitive edge in adopting digital assets. As Metaplanet's strategy unfolds, it could serve as a catalyst for regulators in Japan and globally to develop more streamlined frameworks for institutional crypto adoption, balancing innovation with investor protection. The success of such initiatives could even influence regulatory evolution in other countries, fostering clearer oversight for crypto assets. Market reactions to these corporate Bitcoin acquisitions are closely watched and often reflect broader investor sentiment. Following Metaplanet's announcement, its share price experienced a modest dip, indicating some market caution, while Bitcoin itself saw a price correction, highlighting the inherent volatility associated with these significant corporate moves. However, the underlying trend suggests growing institutional confidence, gradually normalizing Bitcoin as a legitimate asset class within corporate treasuries. The potential rewards are substantial. Bitcoin offers a hedge against inflation and currency fluctuations, and its low correlation with traditional assets can enhance portfolio diversification, potentially leading to improved risk-adjusted returns. Yet the risks, including market volatility, evolving regulatory landscapes, and security concerns, require careful management. As more companies embrace Bitcoin treasury management, the implications for financial regulations, market dynamics, and corporate strategies are profound, shaping the future of finance in the digital age. With companies making bold moves into Bitcoin, it's crucial to understand the underlying asset itself. Let's talk about how Bitcoin's own characteristics are paving the way for long-term success. Riding the waves, Bitcoin's volatility as a path to profit. In the dynamic world of digital assets, few topics generate as much discussion and debate as Bitcoin's notorious volatility. While some investors are deterred by its price swings, a growing number of analysts and long-term holders view this inherent characteristic not as a drawback, but as a fundamental driver for significant future gains. Understanding this perspective is key to grasping Bitcoin's potential as a wealth-building tool. This narrative focuses on how Bitcoin's price fluctuations, often perceived as a risk, can actually be a crucible for forging substantial long-term returns. The argument is that the very volatility that makes day trading challenging also presents unique opportunities for strategic accumulation. For investors with a long-term horizon, periods of sharp price declines are not necessarily signals of failure, but rather advantageous moments to acquire more Bitcoin at a lower cost basis. This strategy, often referred to as dollar-cost averaging or simply buying the dip, relies on the conviction that despite short-term fluctuations, Bitcoin's underlying value proposition and network effects will lead to significant appreciation over extended periods. The historical data, while not a guarantee of future performance, shows periods of dramatic drawdowns followed by even more dramatic recoveries and all-time highs, reinforcing this long-term bullish case for many. Furthermore, Bitcoin's volatility can be understood in the context of its relatively nascent stage as a global asset class. Compared to traditional assets like gold or equities, which have centuries of market data and established infrastructure, Bitcoin is still in its developmental phase. Its price discovery process is influenced by a wider range of factors, including technological advancements, regulatory news, macroeconomic shifts, and evolving investor sentiment. This makes it more susceptible to rapid price movements. However, as adoption increases, institutional participation grows, and regulatory clarity improves, many experts predict that Bitcoin's volatility will gradually decrease, becoming more in line with traditional assets. Until then, its current volatility can be seen as a feature that rewards patient investors who can withstand the short-term turbulence in exchange for potentially outsized long-term gains. It also distinguishes Bitcoin from stablecoins or traditional currencies, offering a different kind of potential return profile. The market's reaction to Bitcoin's volatility is multifaceted. While short-term traders might be shaken out by sharp downturns, long-term holders often see these as opportunities. Analysts frequently point to the increasing hash rate, network security, and adoption metrics as evidence that the underlying technology and ecosystem are strengthening, even when the price is down. This resilience in the face of price swings builds confidence among those who believe in Bitcoin's disruptive potential as a digital store of value and a medium of exchange. Ultimately, the narrative around Bitcoin's volatility is shifting from one of pure risk to one of opportunity. For those who believe in its long-term vision, the price swings are not just noise. They are part of the journey towards establishing Bitcoin as a significant global asset, potentially rewarding those who stay the course. That wraps up our deep dives for today. But before you go, stick around for a quick recap of all the top stories and your essential call to action. And that's a wrap on today's essential updates. We've seen Bitcoin forging a new path, diverging from gold, potentially signaling a strategic entry for institutions, becoming a core corporate treasury asset, and proving its volatility can be a launchpad for long-term gains. Don't miss out on any of these market-moving stories. Make sure you're subscribed, hit that notification bell, like this video if you found it valuable, and follow us on all our social channels for even more insights. We'll see you in the next one.